Today, I want to be specific. We're talking about the 4 reasons why real estate just picked up again. If you're a real estate agent, are you feeling it? If you're a lender, are you feeling it? What is happening? Because rates are going up. So that's what I want to talk about. We're into the next Fed meeting. It's happening, what's today? The 20th and 21st. We're going to get the vote on how high Powell and the rest of the Fed is going to raise their Fed rate. So speaking of, I want to start out with what's happening with rates, because that seems really important against the backdrop of real estate getting busier. So interest rates are up. In fact, the 10-year Treasury just hit a high since 2011. Yesterday it hit 3.51. It's already above that this morning. Last night, while we were sleeping, Sweden raised their prime rate by 100 bips or 1%. Fed has on the table today 0.75%, or at least that's what they leaked to Nick Timros with the Wall Street Journal. Now, there's many economists that are talking about the fact that the Fed might do 100 bips or 1% and match Sweden. But will they? Because we know they have to aggressively attack inflation. We know employment is good. Like beyond good, it's stable. The jobless claims continues to be low because even those companies who are laying off or slowing down on hiring, those people are finding other jobs. There's 11.2 million job openings. Those people are finding other jobs. So unemployment is low, employment is solid. The Fed now can turn to a single mandate, which is inflation. So we're seeing them attack the Fed rate. That Fed rate is upsetting the market. And then, of course, you've got something like what happened to Sweden. So we're seeing interest rates still rise. At what point will we see them drop? I mean, I'd like to call it. But if I do, I'm going to be wrong. And anybody who tries is. But the Fed will push us into a recession. They've already said that this is going to be painful for households and businesses. And when it is, things will slow way down and consumers will finally stop spending. Consumer spending is 70% of the GDP. Consumers are propping up our continued expansion, even though it's been slowing down. We need everybody to stop spending, even if just for a minute, and allow the economy to slow down, push us into a recession to get the rates to drop. So rates are still going up, yet when I'm talking to real estate agents, they're saying, I just had a pickup. I think we're going to have a really good October because September was really quiet for a lot of people. So if October is going to be busy, why? Have you seen the realtor.com article that I posted in the Saturday blog? If you're a real estate agent and not signed up for the Saturday blog, you need to. Plus, we have a new Friday update text that is going to be a few simple lines with what's the interest rates going into the weekend and what's the one thing you need to know. We'll put the text number down below so that you can get signed up for that. We're constantly looking for new ways to share this information, because realtor.com put out an article talking about the fact that the last week of September, which tips into October, is the best buying week for buyers, right? Not the best time to sell, but it's the best time to buy because we have more opportunity, more inventory for sale with less competition because mortgage purchase applications are down going into the holidays. So those buyers looking to purchase can do so and get a price reduction. They can use FHA or VA or down payment assistance or even 2 down payment assistances. They can get inspection items resolved during the contract period. These things are things that first-time home buyers haven't had. So that's coming up. The best time to buy a home is right around the corner. So why else are we seeing things picking up and people wanting to go out thinking that October is going to be good again after maybe a slower September? Now, I'm not speaking for everybody. We had a pretty big September, but we're already seeing the pickup as well, and I love it. So here's 4 reasons why. There's a lot of conversation and a lot of news right now about employers calling employees back. Now, there's a lot of debate and there's some battles between employee groups and employers because employers are saying school's back in session. It's time to get back to work. Come back to the office. I don't want to go back to the office. I'm used to living in the foothills or in a different city or closer to my family and working from home or working remote. But employers are wanting people to come back. So that's causing some people who moved away to have to move back. Or the second reason is employees are saying, I don't want to go back. I'm going to go find another job. And on average, employees get a 10% raise when they change employers. And don't tell my team I said that. So that happens, right? And we all know that happens when you go out looking for a new job. So you've got employers calling employees back. You've got employees out looking to change jobs. And you also have these first-time home buyers who are getting an opportunity they haven't for the last 2 years. Now, interest rates have been high, but they've been high for a while now. We went up, started to go up in March. Now, a year ago, a little over a year ago, we were hovering around just under 3%, and now we're at 6.25%. In fact, I was looking at it last night. It hit 6.4, with the 10-year hitting its highest since 2011. So a 6.4 interest rate, you're talking about over a 3% hike in interest rates. That affects affordability on top of the 44% appreciation that we've seen in the last 2 years nationwide. Those kinds of numbers are hard to swallow, yet we hang on to the fact that real estate truly is the key to long-term financial stability and wealth. And if I don't get in now, then when? Because rents are also going up. So if I get in now and lock in today's home prices, and you've heard the slogan, right? Date the rate, marry the house. So if we marry the house at today's price and interest rates do go down when a recession comes, then as a first-time home buyer, I can take advantage of things like OneTrust 3-2-1 buy down or the 2-1 buy down or seller concessions or all of the inspection items that I could get fixed. And yes, the home price is more than it was a year ago or 2 years ago. But if interest rates do go down during a recession that we might see next year, my gut is telling me the end of spring next year and interest rates will go down, but from what? If interest rates do go down and we see demand pick up, all this demand that's kind of been pent up the second half of this year rolls into 2023. Because remember, I don't care how you slice it, the demographics coming into 2020 were still massively in a buyer's, not opportunity, but competition. You guys were fighting for those homes. We have had less homes as we haven't kept up with new builds for over a decade, fighting for those homes. And then, of course, COVID and everything else happened. And we know the story, but inventory is low. We still have not recovered to 2019 levels. So when interest rates do go down, and even a little bit, people love to buy on the dips. Who doesn't love a good sale? And if people love to buy on the dips, then buyers are going to come out of the woodwork. And those buyers who didn't buy now, yes, even at today's home prices, will end up paying more when rates go down because of more competition, right? I mean, that's just supply and demand. I don't have to be a scientist to figure that out. So if interest rates go down and demand spikes up, and then all of a sudden you got multiple bids, and the FHA and the VA and the down payment assistances are kicked back out again because people are bidding, if not 100 to 200,000 over asking, just even $25 to $50,000 over asking, because it's not going to be as intense as it's been the last 2 years. It still knocks out those first-time home buyers who have a wide open opportunity right now. Right now. That's why, because interest rates, yes, have gone up, but now they're just kind of up, right? I mean, right now they're at 6.4 yesterday, national average, and that's not even a real interest rate, but that's an average interest rate, right? 6.4%. So if I look at that, and it's ugly, but I've kind of gotten used to it. I mean, interest rates have been above 5 for a hot minute now. So interest rates going up, interest rates having been up, mentally, I'm sort of getting used to the idea. I'm realizing that if I don't do it now, I might lose my opportunity, so I've got to jump in now. First-time home buyers are knocking on the door of opportunity. Absolutely answer the door, right? This is the time. And then the fourth reason real estate is active, more active than it was last month, is investors. And you're like, wait, what? because interest rates are higher than cap rate. So what does that even, how does that even make sense? The volatility and the loss that we've seen in cryptocurrency and the stock market, investors are trying to figure out where to put their money. And 100% of the time, long-term, real estate always goes up. In fact, Redfin does a quarterly report, and they were looking at investors, and they continue to be strong. Although they dipped slightly from the first quarter, the second quarter, they're still well above pre-pandemic. Investors are still all in. Primarily, they're looking at single families. The median price point here in Denver for investors is $560,000. They're not looking at $300,000 homes, and they don't need to. A $560,000 home is making the numbers work just fine because rents continue to go up. In fact, 17% of all sales during the second quarter were to investors. If you're not talking to investors, you're missing a big part of the market. That was up 17.5% higher than it was last year in 2021. Does that even make sense? Because the home prices are higher and interest rates are way higher, yet 17.5% higher than last year and 17% of the market. There are investors who are slowing down 100%. There are investors that are weighing out their employment situation, right? They're weighing out what the market is going to do. They're waiting until interest rates come down compared to cap rate. They're waiting for maybe prices to drop, which is just unbelievable to even think that that could happen given today's low interest rates. Yes, sellers have to get more realistic in their prices, coming down from expectations, but not, we're still up year over year here in the Denver market, and even strong year to date, really strong compared to our historic numbers. So appreciation continues to be strong. We're seeing investors jumping in, and they know, just like first-time homebuyers, that the competition is down right now, that they can get in and lock in that home price, and then they can refinance it next year when interest rates drop, when the recession comes. Those investors are looking for opportunity and stability in their long-term investment returns, not trying to beat a cap rate today, because there's very few things that will. But do you sit in the sidelines and just stay in cash for the next 12 months, 18 months, waiting for this all to ride? And some people will, 100%, stay in cash, definitely safer, absolutely. But can I get in while others aren't, with less competition, and lock in that home price and start collecting rents, which is still going up, and take advantage of the opportunity? In fact, I ran these numbers. So if I purchase a median home last month in August, the median DMAR 11 county area home price was $579,900. So if I buy a $579,900 home with 5% down, I'm putting down $28,995. If I get a 6% interest rate, right, and I get a 3.8% appreciation, because that's what CoreLogic is expecting that we're going to see for the next year forward, 3.8%. Not the crazy double digits that we've seen, 3.8. Historically, before the pandemic, the United States appreciated 3.6. So we're returning back to normal. So if I have a 3.8% appreciation in 5 years, I have a gain, if that stays consistent with principal reduction every single year, knocking down my loan amount, and a little bit increase in value of 3.8% because I only put limited amount down and the power of leverage, I have the opportunity of that entire home value going up at the purchase price, not my down payment. That's going to give me a net income, net worth of $161,000. I can't make that in the stock market in the next 5 years. Unless your chooser is spot on, because mine's broken, I can't make $161,000 in the next 5 years. And even if we see a dip and a slowdown, which again, because we have so limited supply, but even if the whole secret is don't sell, hold on through the dip and for the next 5 years. And that's where you're going to regain this opportunity. In fact, year one, with a 3.8% appreciation and the principal reduction based on a 6% interest rate, I actually make a 102% on my down payment. I put down 28,995. I'm going to net out in equity gain 29,588. That's just math, right? That's not emotion, that's just math. Well, with OneTrust, we now have investment opportunities that we didn't have before. We have fix and flip loan options. We have land options in construction, one-time VA construction, and one-time FHA construction, 2-time closes. We have opportunities with a bridge loan, which I'm going to talk about on Thursday. If you're not signed up for Megan and I's market update on Thursday, you need to, because I'm going to give you 3 scenarios where a bridge loan can be used to get you into the home before you actually qualify. It's true. You got to watch Thursday for that, because this time was just about the 4 things on why real estate is going up. Well, that's a wrap. This is Nicole Rueth with the Rueth team of OneTrust Home Loans. It's my pleasure to get to do this every Tuesday with you. I hope you guys get excited. And for those of you joining us tonight, which is a weird Tuesday instead of our Thursday, we've got our Investment Empire class, which is sold out. So if you didn't sign up already, make sure to sign up for next month on our second Thursday night, which is always the case. And I'll love to see you there. Bye-bye.